Do you expect the market to reverse, or do you expect the market to consolidate, or do you expect the market to continue? Patterns are going to help you to identify all three of these expectations. Okay, it's also going to help you to it's also going to help alleviate some of the stress that comes from not really knowing what's coming forward. Now, if you're looking at this much momentum in the marketplace, as the market, I guess a better way of doing it would be when you're looking at this much momentum. Okay, you've got the market making a 70 pip move downward. The smart money is not going to bet for an instant reversal to the upside. At the very least, you're going to see a large spike down and then the market close up. But you certainly should not expect the market to reverse off of something like this very quickly, especially with all this momentum here. If you do see the market reverse, it's probably going to look something like this. It's very common. You're going to see a pennant type of pattern start to form up and a break of that particular pennant pattern. So again, this is what I would expect down here. Some kind of flag, some kind of pennant pattern where the market works its way out. I would not be surprised to see this market trade down on Monday, come back down here, and then come back up. I wouldn't be surprised to see the market come down here and break to the downside either. I mean, the market can do anything. But the pattern itself is going to help me to gauge my expectations. If the market is going to reverse at a double bottom, you are not going to see big time momentum coming into it. I mean, just look at this. When the market was coming down to this bottom here, you saw initially some momentum, and then on the next bar, as it approached the support area, momentum just died. Died off, tried to retest, wasn't successful, boom, the market moves up. Okay? All of this, the marketplace will show you the signs, it will show you the code that's in the market if you're open to see it. Now, I've been talking a lot about momentum in the marketplace. With the pound, let me go ahead and bring up, this is something that I really like about Ensign. I've got 200 days worth of data here, and this is a statistical analysis package for that's in Ensign, and it will let me look at virtually any number of days in the history. You can see here I've got 200 days. Now, what I want to focus on here is the daily range. Now, I want you to notice the pound has very few small days. I mean, let's take a look at some of these. If we're just looking at between 40 and 60 pips, out of 200 days, only 22 days fell within these three ranges. Okay, so that tells me that there are very rarely small range days. Now, if you look at this, 150 pips is actually 45 days, which when you factor in the bottom three, remember we're 22 days, that leaves 178 total days, which means that fully 25% of the trading, or the daily ranges for the British pound, were between 141 and 150 pips. So they were fairly big ranges. Okay, so we've got 25% of the daily range in one single swoop right there. But then the rest of the days, look at this, 140 is 10, 20 days at 130, another 20 days roughly at 120. So you're starting to pick up the pattern here. 110 days we're at 13, and then 100 we're at 22. So let's look at this large range here. We've got 25% of the trading days are between 141 and 150 days, or 150 pips. Now, remember, we've got 178 days when we take out the bottom three. So if we have 84 days divided by 178, we've got now 47%. Okay, so 47% of the daily ranges for the British pound are going to be from 100 pips to 140 pips. Now that's some really good information because it will help us to gauge what constitutes momentum. Well, if the market is trading between 100 and 140 pips, I would say that that would be about average in momentum. But once it starts to get up, well, you know, let me be more specific with that. If the market is trading between 100 and 120, this is what I would consider to be average momentum. So between 100 to 120 pips is average. Between 121 and 140 pips, that's above average. And then if it's 150 plus that is actually getting to be excessive in daily range, and that's when I start to anticipate a reversal. But that would be considered to be above normal momentum. So let me go ahead and clear out of here. So the day before, I mean, the market was down, I think some 180 pips roughly. I was just measuring to get an exact number, 181 pips. So that puts it into the category of above normal or excessive momentum. Now, you've got to realize that the momentum has got to be high enough to continue, but not so high that the market takes out all of the participants very, very quickly. In other words, if the market moves down too fast, all of the sellers get dried up and all of the buyers get dried up. There's just nobody else really to trade. You've taken everybody who had an active interest out of the marketplace.